Hello and greetings from UB. On behalf of the Office of Alumni Engagement, we are delighted you are able to join us for today's webinar presentation. As we kick off our fall webinars, we have also just welcomed back our largest first-year class in UB history. The campus is sure vibrant, and we look forward to bringing you these weekly webinars. My name is Christy Fields, and I serve as the Senior Director of Alumni Lifelong Engagement here at UB. And I'm also joined by my wonderful colleague, Joy Rona, who will assist in answering any questions. We are both so grateful you are with us today for this educational opportunity. With that said, we are excited to welcome today's featured presenters, two proud UB graduates, Paul Hammer and Adam Hammer. Paul Hammer, the owner of Hammer Financial Group in Western New York, brings decades of expertise and a commitment to lifelong learning to his clients. Affiliated with Commonwealth Financial Network, an independently owned and managed registered investment advisor, broker dealer, Paul combines knowledge and expertise to help clients not just make money, but also preserve it. After earning a degree in economics from UB in 1978, Paul returned to Long Island, where he obtained an MBA in finance from New York Institute of Technology in Westbury. Paul later returned to Buffalo in 1991 with his family, drawn back by both the area and its snow-filled winters. His dedication to professional growth is evident in his accomplishments. He earned his Chartered Life Underwriter designation in 1995 and his Charter Financial Consultant designation in 1996, both from the American College. Paul also holds the Accredited Investment Fiduciary designation and has completed the requirements for the Accredited Estate Planner designation, maintaining all continuing education credits. With a sharp mind and an enduring passion for financial planning, Paul continues to guide his clients with a blend of wisdom and expertise. Adam Hammer serves as the Chief Investment Officer at Hammer Financial Group and is the co-author of the Smart Investors Manifesto, How Investing the Old Way Could Leave You Behind Post-COVID. As CIO, Adam shapes the firm's investment and asset management strategies, overseeing research for a wide range of investment products, such as mutual funds, ETFs, stocks, and bonds. He is also in charge of maintaining and enhancing the firm's investment models to ensure optimal performance for clients. Since 2014, Adam has partnered with his father, Paul, to help clients of Hammer Financial Group build financial confidence and develop personalized strategies to achieve their goals. Together, they blend expertise and innovation to simplify investments for individuals and families. Adam holds a bachelor's degree in political science from Mercyhurst University in 2009 and a master's degree in finance from UB in 2014. His dedication to continuous learning is evident in the professional certifications he has earned from the College of Financial Planning, which include the Accredited Asset Management Specialist and Chartered Retirement Plan Specialist. A talented communicator, Adam is also an award-winning speaker through Toastmasters International. His commitment to his alma mater is reflected in his active involvement with UB. He's even tackled challenges outside of the office, completing both the Buffalo and Myrtle Beach half marathons. When he's not managing investments or speaking at events, Adam enjoys reading horror-inspired spy novels and cheering for Buffalo sports teams. Today's session will speak to how rising tariffs, AI breakthroughs, energy price swings, geopolitical tensions, and global events influence financial markets and stock returns. Paul and Adam will explain how these forces impact investments, sharing practical insights and real-world examples along the way. We will leave time during today's webinar for Q&A. If you have any questions during the presentation, go ahead and use your Q&A button on your Zoom taskbar and send those to us at any time. In addition, we will be recording today's session and we'll send you all a copy within the next 24 hours. Lastly, go ahead and check the resources icon on your Zoom taskbar. There is an ebook that both Adam and Paul have so graciously provided for all of our attendees. So check the resources icon and download that. And now it is my pleasure to turn it over to our featured presenters, two proud members of our UB alumni family, Paul Hammer and Adam Hammer. Welcome, Paul and Adam.
Yes, thank you, Christy, for that very nice introduction. This is Adam Hammer along with Paul Hammer. We are unraveling the forces shaping financial markets, tariffs, AI, energy prices, and global conflict. We're very excited to be here. Thank you for the opportunity, and we have a great presentation planned for you. Before we get into the presentation itself, I do have to just go over this quick disclosure information for all of you watching. Just remember that this presentation is informational and educational only, should not be construed as investment advice or a solicitation or a recommendation to buy or sell any security or investment product. And some of the things we're going to tell you are forward-looking statements. They're based on reasonable expectations, estimates, projections, and assumptions, certainly not guarantees, and past performance is not indicative of future results. We've got our office right here in Lockport, New York, not far from North Campus. And if you do have any questions about the graphs or the figures and so forth, that will be provided at the end of the presentation, and we can provide that to you. All right, so first off, our goal in this presentation is more than just information. We want this to be things that you can take action on kind of immediately after you're done watching. So this isn't just information. We want it to be actionable, and really our primary goal of the presentation really comes down to one thing. We want to be able to help you potentially make more money as an investor. We want these ideas to resonate with you. We want them to be valuable and things that you can implement and use, and you can say, oh, wow, this wasn't just information I forgot, but things that I can actually go home today and use immediately.
Yeah, and one of the items that we often get questioned on is how do we know when the market's moving higher or when it's going to go through a tough period? And in general, what makes the stock market go higher? And if you're keeping notes, this will be the first actionable item. And the word is earnings, earnings, earnings. When corporate America reports their earnings and their earnings fly past the analyst expectations, that tells us the company is doing very, very well, and therefore their stock price is undervalued, and it jumps up in value to keep pace with the revenue that they're reporting. Is also the part of the earnings season, and we are at the tail end now of the second earnings season. There's 4 of them through the year, every 3 months, and we're at the tail end of the reporting season. And also, once they report their earnings, they will also offer expectations into the future. And as long as that has positive vibes to it, that will also move the market higher. What happens is when most of the companies are reporting positive returns and higher earnings, if a company comes in and misses, they usually get hurt and their stock prices will fall. So when you're looking around to say, okay, where should I maybe allocate some money to, you want to be thinking about what companies are earning and if their forward guidance is positive. So at the end of the second earnings seasons here, not only is corporate America reporting record profits, and it's more than just the AI companies who have done extremely well. 78% of the companies that are reporting positive returns and higher numbers than the analysts had predicted for them. And with that, they're passing that number by a cool 8%. So in general, the bull is in charge, the market's moving higher, corporate America is very healthy.
Very good. And we'll talk a little bit more about the market and earnings. Before we get to the meat and potatoes, though, we do have to talk a little bit about fundamentals. This is the roller coaster of investing. This is the emotional part of investing. We're showing this slide because all of us deal with emotions, and emotions impact investors and our returns, how you manage your 401k accounts, your investment accounts. If you take a look up on your slide, you can see on the left side, market performance, arrow pointing up is positive, arrow pointing down is negative, and you can follow the roller coaster of investing, right? The market's moving up, we're confident, then we become euphoric, then all of a sudden maybe the market goes down, we're nervous, then we become desperate, then maybe we're defeated, right? Maybe this past April you felt defeated. We'll talk about that in a few slides, and then we become hopeful again. So this is something we all deal with, and it can really impact whether we get the kind of outcomes that we want.
Yeah, and Adam and I also deal with this. We're not immune to it. It's just that we've been through it enough times. We have the resources to know what to do under any market condition. So therefore, as much as it does bother us, we're able to calmly work our way through it. As I just reported, with the record earnings coming in and the positive guidance, we're probably in that euphoric phase. Everything is going just as well as it should, and who knows where it starts to turn back down. But nonetheless, the markets do go through these type of swings. But as I mentioned, right now the bulls are in charge. We're going to mention the word volatility a number of times as we go through slides, and we have additional slides that we're going to show you. But for today, we want to focus just on two parts of the market. The market's made up of many players, but today we're just going to worry about traders and investors. Investors in general are long-term folks who are putting money away for the long term. You shouldn't get emotionally involved when the market has its swings, as long as you have a long-term horizon. But we also have traders, and traders are looking for short-term profits. They might buy when the market opens at 9:30, sell at 10:30, and buy back the same stock at 1 o'clock and sell it at 3 o'clock. So depending upon what news comes out and how they think it might affect the holdings they have, they buy and sell on a regular basis, trying to make some profits. One item that I want to bring up that we don't actually have a slide for, but it also is an item that you can keep note on, and that is known as the VIX, V-I-X. It is an index of fear, if you will, in the market. So when we're at that part of the graph where it says confident, the VIX is going to be low. And we say low, somewhere around 13 or 14, and stable or falling as you go up to euphoric. And then as you start to fall down and move towards the nervous, that VIX will begin to grow. It will begin to move higher, and the key number is 20. Once it goes to 20 and higher, that's where Wall Street starts to get nervous. And you can also then say, okay, if the VIX is over 20, this might be a time to take some profits or make a small change to my allocation. But that is another tool that you can use as we move through the market.
Yeah, and I'll just point out one more thing on the slide before we go to the next one. You can see euphoric. If you look at that dotted line, you could say that's kind of the riskiest time, right? You've probably heard the expression buy low, sell high. That's kind of what's coming into play here. And then you go over to defeated and you see that dotted line go all the way up. That's the best opportunity to make money. We're going to show you a real world example of how that just played out a couple of months ago. Paul had mentioned volatility, and this is a slide that I think is really interesting and kind of shows it in a way that you may not have seen it before. First off, this is the S&P 500, the U.S. stock market over the last, from 1980 to the present to 2025. And you'll see that the calendar year returns for the S&P 500 are on top. So you can see these bar charts, and you would say, okay, well, most of the time the market is positive, which is true. But what you'll also see is there's red dots beneath every single year. And you would say, okay, well, what the heck does that mean? Well, those red dots are what's known as intra-year declines. So if we take a look at 1980, which is all the way on the left side of your screen, you could say, all right, 1980, the market, the S&P finished the year up 26%. But at one point in 1980, the market was down 17%. Holy cow. Think about that roller coaster of investing. You probably would feel pretty defeated and pretty despondent if that was what the market returns you were looking at. But that's volatility for you. Even though it was down 17%, at one point in 1980, if you hung on for the year, it finished up 26%.
Just think if you had this information today and you could go back in time, like the movie Back to the Future, you could be in 1980 and say, okay, the market's now down 17%. I think I'll buy. Everyone else will think you're nuts, but you know what the future holds. You'll also notice that between every one of those bar graphs is a red dot. There is not one year from 1980 where the market started positive and stayed positive. Even going to this year, all the way to the right, year 25, Yeah, we were down 19% earlier this year. So you need to make volatility your friend. You need to look at it and say, when the market goes through difficult times, that's my opportunity. And I'll just point out a couple things that you may have lived through, or maybe you weren't around yet to experience it. But if you look right around 1995 and you come up, you'll see 5 bar graphs in a row: plus 34, plus 20, plus 31, plus 27, plus 20. So that was a great time to be very aggressive and in the market. And yet below each one of those is a negative number. But that was volatility. And if you can use volatility to your advantage, you did very, very well. But something happens right after the year 2000. We get 3 years in a row. So we went from that euphoric phase all the way down to desperate and finally defeated when the market had its 3rd year down of minus 23%. That was a very, very difficult time to stay in the market. But for those who did, the market did come back, as it always does. It goes up about 75% of the time. When it goes down, it's about 25% of the time. But when it goes down fast, it goes down hard. And of course, the media loves it when it goes down. It's known as fear sells. If we can scare you, you'll keep clicking buttons and coming back to us. So this is history, but this tells you how the stock market works. Volatility is part of it. It's normal. Nobody knows exactly what's going to happen, but we do get clues and probability.
And if you take a look on the right side of your screen, all the way to the right, that's year to date. So in 2025, at one point we were down about 20%. We'll talk about that in just a moment. But as of the time of this presentation, we're up about 8%. So there's volatility for you in real time. All right, let's talk about the average investor, though. The average investor is struggling and missing out on returns. How do we define an average investor? Well, probably someone who didn't study finance or investing in school. They don't work in financial services. They're doing this on their Ameritrade account or their Robinhood account. Part of the issues, of course, is bullet point number 1, right? Emotion is costing many investors money. We talked about the roller coaster in investing and how emotions can really impact us. How about bullet point number 2, following advice from TV personalities or from your neighbor? Paul and I have a client that called us once and said that he wanted to invest money in Rite Aid, the pharmaceutical company. And for those of you paying attention, Rite Aid doesn't even really exist anymore. It declared bankruptcy a couple times, and that investment went to zero because he was listening to his neighbor who probably doesn't have any background in finance. Why he wanted to do that? Well, he listened to his neighbor, and that wasn't a good idea. And then the third bullet point, of course, clinging to bad investment ideas. Some people are stubborn. You have to be able to be adaptable and flexible. Sometimes that means buy and hold. Sometimes it means reducing risk, but you do need to have some flexibility if you're going to be a successful investor. And if you take a look at these 2 bar charts here, you can see that the average equity investor, that's the one in gray, this is from 2004 to 2024. If you had invested $100,000, the average investor returned about 9% over that period, $585,000. But take a look at the blue bar chart. That's the S&P 500. That returned over the same time period, a little over 10. You might say, well, okay, only 1% difference, but look at the dollar amount: more than 100,000, 131,000 outperformance over what the average person is doing. So that's a lot of money to kind of leave on the table. And of course, if you see bond investors, which is those 2 smaller bar charts, kind of the same thing. The average bond investor is falling behind as well.
Yeah, so it may not look like a lot of money, but when you take a difference of 1% and compound it over 20 years, that's when you get the big number between those differences. Also, with that story about the Rite Aid client, we cautioned them. The internal numbers on the Rite Aid just didn't warrant us. It wasn't on our buy list, that's for sure. But again, it was somebody who he thought was in the know, even though the economics and the math behind it didn't warrant it, and he kind of went forward and did that anyway. I often ask people that, when you're at a party or something and somebody, as in this case, Rite Aid, I think the first question you should ask them is, where did you study finance? Or do you work on Wall Street? what makes them an expert? I always think it's hilarious when some movie star parades himself on TV or something, saying something about, some part of society or something. And I'm often wondered, like, what makes them an expert? They went to acting school and were in Hollywood, but for some reason, people seem to think they might know more than we do. So, yeah, you just always have to make sure that the resources that you're using to make your decisions are solid. Certainly, if you look to invest in individual stocks, you have to be very, very careful. Whereas if you choose mutual funds or ETFs, where you're going to get a basket of investments that reduces your risk, increases your chances for a return.
All right, now we're getting into the stuff you're hearing on the news all the time, tariffs, big bad tariffs. Maybe you're tired of hearing about tariffs, but I think we're going to continue to hear about them. So just as basics here, what are tariffs? Tariffs are taxes that the government places on goods that are imported from other countries. You can kind of think of it as a fee that's added to the price of foreign products when they enter the United States. The next one here, who pays the tariffs? That's kind of a hot political debate at the moment. Technically, the importers and the businesses that are bringing those goods into the country pay the tariffs to the government. Then those increases can be passed on to consumers, which could cause inflation, which is kind of the hot debate at the moment. That doesn't have to take place. Sometimes businesses can choose to not pass on the cost or play around with production and so forth. But that's kind of the nuts and bolts of tariffs and what they actually are.
Yeah, I believe that this current administration is using tariffs mainly as a negotiating tool. They went on TV and had all sorts of crazy numbers up there that I'm sure sent shockwaves through the international markets of how much it's going to cost to sell their products here in the United States. The administration wants a better deal than what was on the table. I'm sure they're going to get it, but the numbers that they throw around, I'm sure, are going to be watered down and come way back down so that it's something that all the countries that we're dealing with have a good deal and they can continue to sell their products here in the United States. But we had to increase those products so that they're competitive with the products that we make here in the United States. And again, this is what the administration is trying to accomplish so that the goods here in the United States and American workers' jobs are protected somewhat. As an offshoot, I have found it very interesting that tremendous amounts of investments are now being made to build factories here in the United States by American corporations. The big push for semiconductors and these data centers, which were planned to be built overseas, are now being built here. There are car companies now, foreign car companies, building the manufacturing facilities here because if you build it here, you don't have to pay tariffs at all. And just recently, they signed a deal where South Korea is going to get back into helping the United States build ships. South Korea has a big shipping industry, so they're going to get hit with tariffs. But part of the deal is, okay, the tariffs will come way down, and they're going to help us get back into shipbuilding. So, tariffs can be used in a positive way. There's a lot of negative news immediately when the tariffs came out. Well, we're going into a recession, inflation's going to run away, loss of jobs, and lo and behold, none of that's coming true. So again, the experts, just as they were wrong when COVID hit and how everything was going to go and be a disaster, they were dead wrong again that this hasn't happened.
All right, but there were some scary moments here on the way to talk about this tariff discussion. You might remember this, right? Liberation Day, April 2nd, 2025. I think all of you were around here in April when this happened. So the president implemented a tariffs, a 10% minimum tariffs on all U.S. imports, and there were some higher rates on China. And boy, the stock market was not happy with that announcement. In fact, if you look at the second bullet point there, the S&P 500 dropped over 11% in 5 trading days. It was one of the steepest declines really since we've been keeping track of the S&P. I remember that announcement came on Wednesday, and then Thursday and Friday. The news was just apocalyptic. The end was near. The joke going around was that we would all be liberated from our wealth because all of our accounts would go to zero. The market would go to zero. It was some of the most intense fear really that I've been a part of. And it was scary. It was scary for people to watch, and even for people who do this professionally, like Paul and I. We're human beings too, so we all have those emotions to deal with. What's interesting is what comes next, but certainly the initial reaction wasn't very positive.
Yeah, it's a very interesting time. We have a number of tools in our toolbox that tell us with strong probability that what was happening was going to be short-lived. We'll get into that in a little bit further, but you have to go back and realize this administration loves to create chaos. If you remember, we were just going to annex Greenland to be the 51st state. We were going to rename the Gulf. I think they did that. Then we were going to do something with Canada. We're just going to, take over the country or something. So I think they like to create chaos, get everybody all excited, and then sit down and actually make a deal that's beneficial for everyone.
Right. But speaking of all that politics, what about the investor impact? Okay, we kind of know what happens. So how should you approach this as an investor? Well, here's a takeaway for you. Bullet point number one, every 5% decline, hold your nose and buy. Uh, these steep declines are very scary, but keep in mind that when the stock market and these broad-based indexes drop about 20%, you really have to start considering getting back in. When you have those big declines, we're probably not going to zero, even if they tell you that on TV. And every 5% decline that you see in the market, that's an opportunity to get in at a lower price, right? You want to buy low, sell high. So you're getting it on discount. And it's very difficult to do. Your body is screaming, your mind is screaming, sell, 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 sell. But when you see these big declines like we did in April, you have to sort of buckle up a bit and say, okay, as long as I'm that type of investor and I'm looking to get an entry point, every 5% decline, hold your nose and buy. Number two, the bullet point is rapid declines are often followed by V-shaped recoveries. We'll show you what a V-shaped recovery actually looks like. But again, that's a takeaway for you as an investor. When you see rapid, really, really quick declines, we usually see big recoveries that happen pretty quickly. That's what a V-shape is. We'll show you that in a moment. Now, speaking of those politics, right? April 2nd was the announcement of Liberation Day. April 9th, well, we've got politics in play, right? We're going to pause these tariffs and we're going to leave more time to negotiate. Well, what happened? So on that day, the S&P 500 soared 9.5%. It was its best day since 2008. The Dow Jones jumped nearly 3,000 points, up almost 8%. And how about this? The NASDAQ surged 12.2%, its largest one-day gain since 2001. And since we hit that low in April of 2025, the US markets to date are up about 25%. So again, a rapid decline, usually rapid recoveries, and you can see the importance of, hey, you know what, if I had gotten out of the market entirely because I was fearful, I would have missed out on the big rebound. So it's always a good idea, depending on who you are, to make sure you have some money allocated.
Yes, we've got a number of interesting points on this slide here. So certainly the first one, every 5% decline, hold your nose and buy. That can be your strategy. That can be your plan. And I can't emphasize enough how you need to have a plan in place so that when events like Adam just went over happen, you know what you're going to do. You're going to, take 20% of your riskiest assets, move to the sideline. You're just going to stick it out. You have to have a plan in place so that you don't make poor emotional decisions. Also, they have in there the pauses announced. So then the S&P soared 9.5%. The media is fantastic with this. It soared, it plunged. They use all sorts of words to get you emotionally involved. So if it soared 9.5%, well, how much was it down to begin with? And maybe soaring 9.5% really isn't that big of a number because it followed a drop of 15%. So you have to have a scale involved. You have to have that information and the knowledge to realize that, okay, they're just trying to get us excited about things. But, you need to know the numbers and what they actually mean before you can decide whether we're in trouble or not. So Yeah, that's great information. But again, you can have a plan and a strategy. Every 5% decline, you could have one that says every 5% advance, I'm going to sell a little and allocate somewhere else. Again, having that strategy and plan is important.
All right, so what does a V-shaped recovery look like? Well, you can see up on your screen, this is kind of what a V-shaped recovery looks like. This is a chart of the S&P 500 starting from January of this year. And you can see, we kind of trended water for a long time. Then in the winter time, we see this decline. And then boom, the tariff announcement, this huge drop that we just talked about. But then we get to pause, then we're going to negotiate, and look at that, right? We get the big bounce back and boom, it looks like a V. Recoveries don't always look like this, but again, to reiterate, big declines often followed by big rallies. And if you took our information here and said, okay, once the market's down about 20%, time for me to get back in. If you had done that right around April, look at your return now. You're looking pretty good.
Yeah, and if you want to have some fun, you could look at what the VIX was in late February when the market started to decline, and then certainly when it spiked and fell, the VIX went off the charts, and that was one of the telltale signs that the worst is probably over. When things get to be the extreme, and even the VIX, that index was at the extreme, it kind of told us that okay, that's probably all that's going to happen. And then you had the pause, so it almost sounds like they all had this coordinated. But there are other tools that tell us whether drops are going to develop into something bigger. A big one is consumer sentiment. How do people feel about the way things are going in the economy? That was still rock solid. Trading patterns of who's buying and who's selling was telling us this was done mainly by the traders who were just making daily decisions, not investors pulling out of the market. So we had enough clues telling us that this was going to be short-lived. We didn't know there was going to be a pause, but it certainly helped us to hold on during a very stressful time. And we were rewarded when the market did come rallying back. So again, we have tools that we use that can help us through those times. I just want to mention one other item since this happened in May. There's a famous saying out there that's really totally useless because there's no facts behind it. Sell in May and go away, with the analogy that everyone on Wall Street goes out to the Hamptons for the summer and therefore sell all your stocks because nothing good will happen until they come back in August and September. If you had followed that and gotten out, not only would you have gotten out at the worst part, but then you would have missed most of the rebound.
All right, now we get to talk about AI. The Terminator maybe is coming to visit us soon. All right, so what is artificial intelligence? Well, it's a revolution in technology. It's a field of computer science. It's focusing on creating intelligent machines capable of tasks requiring human intelligence. And how about this quote from Tim Cook, who's the CEO of Apple? We don't fear AI taking over. We fear not being in control of how it grows. All of you listening have dealt with AI. If you've ever asked Siri a question, that's AI involved. I'll ask Alexa a question, that's AI. GPS in your car is using AI. And one of the big things that's so different about AI than from sort of the past technology is that AI creates, right? It has the ability to create things. If you've been on any one of your favorite social media channels, whether it's X or Instagram, TikTok, I'm sure you've seen the cat videos playing the violin while tap dancing on a canoe, right? It's all about creating videos and pictures and text. You can adjust your own photos from years ago and add a video to that picture. It's really incredible what AI has been able to do. The number of users who are using or involved with AI is just growing exponentially. It's kind of infiltrated every industry, every area of life, and it's also impacting the market as well.
It's been compared to possibly the Industrial Revolution, with the impact that it's going to have. An analogy that I saw said, well, if we needed to build a new road on the North Campus, in the old days, we had to have 100 workers with shovels, pickaxes, and wheelbarrows. It took forever to build and was costly as well. enter the combustion engine, the Industrial Revolution, and all of a sudden we have bulldozers, other equipment that can move the earth very quickly, and we have maybe a dozen men working, and the road gets built in no time and at a fraction of the cost. And that's where they're comparing AI to it. The type of jobs that can be done by AI will not actually eliminate jobs, but they're going to create jobs that we don't even know what they are yet. That's the fun part. So that those folks who are doing those jobs that are eliminated are actually going to move up the pay scale and actually find more gainful employment, better employment for themselves, and the company will be more profitable and their stock price will go up.
Yeah, and speaking of the stock market, take a look at this on the left side of your screen. This is the year 2000. This is the top 10 S&P 500 companies. In blue, you see General Electric, ExxonMobil, Pfizer. These are, utilities, oil, healthcare. That's the type of companies that were kind of at the top in 2000. If you go all the way to 2024, 24 years later, where I've got the yellow circle, take a look at who's leading the stock market now. Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, Tesla, Broadcom, right? These are all tech companies, and they're all using AI in one form or another. And from an investor standpoint, where's all the growth in the market been? Well, it's mostly been in tech. It's mostly been with companies using AI. And that's such a huge change from where it was 20 years ago. And we would expect and anticipate that technology is going to be leading the market higher moving forward as well. Now, this is just the component parts of AI, because sometimes it's like, okay, well, how do we sort of divvy this up? What does it really mean? Well, first off, you can't talk about AI without talking about semiconductors, right? If you ever Googled a picture of a semiconductor, it looked like a little computer chip. But you can't have AI without semiconductors. The big player there is NVIDIA. They're all over the financial news. In fact, they announced their earnings today, so the market's kind of holding its breath because if NVIDIA has good earnings, which is what is expected, we could probably anticipate the market will move higher, right? That's how important NVIDIA is to the stock market. But NVIDIA is the one, producing those semiconductors along with some other companies, and that's, the necessary electrical component to generate AI. Then you kind of go to the infrastructure part. This is like a company like the Eaton Corporation. They have these big data centers where the processing and the power that's needed to bring AI to life has to sort of be stored in a way somewhere, processed somewhere. And this is where Eaton Corporation is coming in, and they're involved with everything like aerospace systems and power management. So that's the infrastructure part of AI. And then the part that maybe you're most familiar with and that we're all familiar with from the user end is companies using AI in their products, like Microsoft with their cloud and software programming. I mentioned all of the different videos and pictures and text that you can create. And pretty much every company, it seems, is implementing some type of AI. In fact, I'm sure your jobs, wherever you're working, has some part of AI that's using, whether it's the software that you're using or whatever. So it's really huge here.
Yeah, when we talk about semiconductors, it was something that kind of makes sense for me, and now I understand it better. From every electronic device that's out there, just from a simple toaster to the most technologically advanced home theater system, uses semiconductors. So it's more or less, if there's some sort of electric power involved, there's semiconductors involved, and that's why there's this big push to build those products here in the United States rather than overseas. One other item I just want to clue in there, we've been talking mainly about the big companies, the tech companies. They are certainly pulling and leading the market, but last Friday, Federal Chairman Powell left open the door for an interest rate decrease, and the market jumped on that. And what that does is it brings back the small caps into the market. They thrive when interest rates are falling. And so with that, recently we've seen a big surge in the small caps and the financials. They do very well when we're in an environment where interest rates are falling. So if you're looking for another possible clue on what to do, there you go. If we have falling interest rates, small caps can be a very good choice.
Yes, and speaking of investing, we talked a lot about tech. I just want to make it clear that this is everywhere: utilities, financial services, healthcare, communication services. So, for example, financial services, we just talked about the big drop in April after Liberation Day. That big drop was AI. That was AI trading algorithms. It wasn't really, financial advisors clicking buttons in their office. That was AI trading that caused the big, big decline because AI is reading those headlines and putting in those sell orders. And Paul, I know you had a story about healthcare, right?
Yeah, recently I had a family member needed their gallbladder removed. So we arrived early at the hospital. I was prepared for the waiting room with a book, my Sudoku puzzle, and a crossword puzzle. I was originally online saying, okay, this is going to be, maybe 2.5, 3 hours. And 45 minutes later, they called me into the recovery room. It went so quickly because it was done with those robotic things, which makes 3 small incisions, and there's no big recovery time, no big sutures, and we were on our way home in no time. So that was certainly shocking to me that they could get that done that quick. I will also mention that as we look at communication services, of course, with all this advancement in technology, we also know that there's all sorts of bad people out there that are going to try and create all sorts of fraud. So when you look at possible areas that might look interesting to you, certainly on understanding cybersecurity needs are going to continue to be needed and increased is another area that's ripe for your investment considerations.
Yeah, and this next slide is an example of an investment fund that's largely based in tech and AI. You could certainly Google certain types of specific investments. We're going to refrain from that because everyone's situation is different. But this is kind of a broad-based type of investment that gets into tech and AI. And just for clarification, what this means is NVIDIA, that's the top holding in this fund. And if you invested $1 in the fund, about 18 cents would be in NVIDIA, and 14, 15 cents in Microsoft, 13 cents in Apple, so forth and so on. So it's very broadly diversified. Sometimes trying to pick the winner, individual companies can be tough, but these type of investments are out there if you look for them.
And it's a nice, easy way to get involved and spread your bets out a little bit, reduce your risk overall of the market, instead you can and still participate.
Right. And just the investor impact, just to show you how big it's been, take a look on your screen here. The blue is the Dow Jones Technology Index, and the orange is just the Dow Jones Broad Index. So the blue is concentrated in tech. This is a 5-year return. Well, look at that difference, right? The tech sector, 176% over 5 years. The broad-based index is at 60. So normally 60 is a great return, and it is, but you can just see how much growth has come from tech, and particularly that AI sector.
So as you build your portfolio, your question is, how much do I want to allocate to that technology sector? How much do I want to have in the S&P? How about the Russell, which is small caps that I just mentioned? How much do I want to have in the industrial growth? So you want to build yourself a strong portfolio. If you go back in past time, tech has had some tough periods to go through. So if you have everything in tech and you go through a tough period, you'll wish that you had diversified better.
All right, let's talk about geopolitics and some war. You might think, well, wars are really bad for the stock market because people are dying, economies collapse, but in actuality, not so much, right? The markets wobble a little bit, but wars rarely impact long-term growth. What you see up on your screen is a hypothetical growth in the market. This is the S&P 500 from 1940 to 2024. All those red dots are different conflicts. And, the general takeaway is, we see some dips, but the trend is kind of up. And although it's kind of maybe a bad way to think about it, wars can be profitable. Certain industries like defense contractors can benefit from war. Sometimes countries spend a lot of money in their economies during times of war. So overall, the market has held up pretty well.
Yeah, I'll just add one item there since I was in UB for part of this time. If you just look at that graph and you come up to where bouts, it might be 1966 over to 1980. That's a 16-year period that we had where we had very high inflation. It was the Vietnam War. There was an oil embargo. We had gas lines if you wanted to get gas for your car, depending on whether you had an odd or an even number. Energy costs were through the roof, which was one of the big determinants of that inflation. And I'm just pointing out that there was a time not that long ago where the market did absolutely nothing for 16 years. If you took dividends and interest out, the S&P would have returned you zero over a 16-year time period. Markets evolve and get stronger and better, just as all industries do. I don't think we'll see something like that again, but we just have to be aware that it did happen.
And just to kind of zero in on a couple of specific numbers here, is just to wrap your head around it. You take a look, okay, the Cuban Missile Crisis was October of 1962. A year later in the S&P, the return was 32%. So you can see in October 62 to October of 63, the market did really well. Now there is a negative number here, 9/11 terrorist attack, September of 2001. By September of 2002, we were negative 16%. But for the most part, things have been okay during war. And then take a look at this last conflict here, the most recent one. We bombed Iran's nuclear facilities in June of 2025. Well, despite conflict and war, oh, this is going to be bad, the market's done just fine, right? From June to August of 2025, market's up about 5%. So an investor takeaway here is if you hear somebody say, well, there's going to be global conflict, there's going to be war, sell everything, you now know that at least historically that isn't true, and that investors in the market have held up pretty well during conflict.
Yeah, so again, we can blame mainly traders on the volatility. Certainly, I'm sure some of the investors do foolish things as well. But for the most part, as Adam said, that graph keeps going upwards to the right and everything comes back.
All right, why don't we talk about oil? And then once we're done, we'll have some time for some questions. So crude oil, black gold, it still powers the world. So much of transportation, electricity, lights, and devices, nearly everything relies on coal and oil. Certainly renewable energies and green energies may come to dominate someday, but that's still somewhat in the future. One of the big takeaways from this slide, and as an investor, is remember that oil and inflation tend to dance together. So when you have higher oil prices, you typically have higher inflation. And I want to show you this chart about inflation because it's been in the news so much and there's a lot of misinformation about it. To keep things very simple, you can see in June of 2022, we had just opened up from COVID. The economy was starting to gear up again. Inflation CPI, Consumer Price Index, was at 9.1%. Wow, that's really high. Things got really expensive. Well, what's the biggest reason for that? Well, the biggest reason was energy prices, particularly crude oil, right? Crude oil prices were high and consumer prices were high because, well, everything needs energy to be transported.
Yeah, the only thing I'll add there is during that time frame with COVID, the government flooded the market with money. If you were a business, you could get interest-free loans. Everybody was getting checks in the mail. Inflation, from my days of studying economics at UB, has always been a monetary policy problem. There's just too much money floating around, but certainly during this period, energy also had an impact.
Yeah, and you can just see from the red arrow pointing down, now we're in June of 2025, 2.7%. One of the biggest reasons, crude oil energy prices have declined, so we have lower inflation. All right, so here's an investor insight. You won't see this or hear this anywhere else, probably. Just take a look at this graph. The crude oil is in red, the Dow Jones is in blue, and you have these yellow circles here. The big takeaway is that crude oil and stock prices generally top and bottom at the same time. So there's a bit of a correlation. So as an example, if you wanted to include energy and oil in your investment portfolio and you were looking for an entry point, you could take a look at the stock market and say, okay, if the stock market we think is bottoming, right? If the stock market was down 20%, chances are that crude oil has probably bottomed as well, and that might be a good entry point. And the same thing on the reverse, if we think that markets are at all-time highs and we've topped, that's probably the same or similar for crude oil prices as well. So there is a correlation there. And certainly for those of you who have those type of investments in your portfolio, that could be useful information how these things are all connected. All right, they're also not going to show you this on television, so get ready, fasten your seatbelts. How about the market during calendar quarters? You might say, well, what does that mean? I thought that the market just kind of does whatever it wants to do. Well, the market maybe will do whatever it wants to do, but there's a history behind it. Take a look on your screen. The blue is the S&P 500. The green is the NASDAQ. Those are the two big indexes in the United States. And if you take a look at the quarter four, right, we're breaking the returns up by quarter, right, 12 months in a year, 3 months in a quarter. You don't have to be a genius here. You can see things are really good in quarter four, right? The first part of quarter four, double-digit returns for both the S&P and the NASDAQ. The second half of quarter four, really good. So here's an investor takeaway for you. Typically, the best time for everyone who is in the market happens in quarter four, historically. But take a look at quarter three. We happen to be in quarter three right now. And what does that tell you? Well, quarter three is actually the weakest period. So again, this is all history. That doesn't mean that we always are up in quarter four, we're always down in quarter three. But if you're looking for certain entry points, or you say, okay, I need to take some cash, I need to reduce risk, or I want to get in, this is really useful information, because you could say, all right, you know, maybe it's time to loosen up in the summertime, but when we get to the later fall, in November and December in particular, things historically are pretty good. All right, why don't we recap everything that we learned here today? First off, research has demonstrated that average investors are tending to miss out on returns, a lot of emotion involved on that. Bullet point number 2, tariffs certainly did cause a big sell-off, but it was very short in April of 2025. Again, that could be a good entry point for a lot of investors. The runaway inflation, economic collapse has not occurred. Artificial intelligence, really revolutionary in its impact in our society. And recent returns have certainly shown that the tech sector has been the sector, the part of the stock market that's really outperformed everything else. That certainly could continue. War and global conflicts really haven't actually shown to impact longer term growth. In fact, there's certain industries like defense contractors that unfortunately benefit from war. Oil prices and inflation are correlated, right? If you have higher oil prices, you have higher inflation, and oil and stock prices tend to top and bottom around the same time. And the last point, which we just went over, the fourth quarter of calendar years tends to be the best time for investors, where the third quarter and the summer months tends to be the weakest. All right, so as an investor, a lot of people will say, where are you going to be a year from now? Most people say, I'll be in the same spot. Well, in actuality, unfortunately, a lot of investors are in a worse place because of the time and the potential growth that was lost. Certainly, if you like what we had to say today and what you heard was valuable, we love working with UB alumni. May not be for everybody, but we'd like to have that conversation, and certainly being part of the UB community is a big plus with us. So with that said, you can check our link out. If you want to contact us, you'll see that on our website, a big pink red box. And I think at this time, Christy, we are ready for any questions if you have them.
Adam and Paul, thank you so much. It's always an honor to have you both join us, and we are so grateful for you sharing your expertise with us. We do have a couple questions, so we'll get started with those. Taking a look at the first question. So Paul and Adam, if tech has so outperformed the broader market over the last 5 years, then is it time to sell tech? Is tech past the top of the growth curve? Your thoughts here?
I don't think tech is done yet. It certainly might be a little extended at the current time, but tech is still exploding. And so to say that it would be a time to take profits from it or reduce our exposure, I don't think that we're at that point yet. There's still too many new things happening, and everything is around tech, and it's across the sectors, as Adam touched base on, utilities and pharmaceuticals and financials, and everything is tech, tech, tech. So I don't see that ending just yet. Certainly there will be corrections and normal pullbacks and all that hopefully won't scare you, but I still think that the bull market is in play and tech is going to continue to lead us.
Yeah.
Great, thank you so much, Paul and Adam. This next question here, two-part question. So taking a look at the first question, are Eaton and Dominion Energy good stocks for AI? So when you're looking at that artificial intelligence.
Yes, that's a great question. Unfortunately, just because of the nature of our business, we can't offer specific recommendations about, companies, whether they're good with AI or not good with AI. I would just say that, every company in some fashion is using AI, but we'd have to look into those a little more specifically and have to talk to that person individually.
We did have the graph, the information with regards to the power that's needed. That power is electrical. So if you're trying to narrow it down as to what industry, what companies might be in that industry, that you can do that. Those data centers that Adam had gone over and these new plants that are being built, their power needs are enormous. So certainly the companies that make up the power grid and are the ones involved in making sure that power gets there would be a way to play it.
Great, thank you. It may be similar, response, but I do want to go to this part 2 question. Is it safe or advisable to maybe switch to Linux to get off that Microsoft roller coaster? With Windows 11 being mandatory by October of this year, and then the release of Windows 12 by 2026.
Yeah, well, we had to update to Windows 11. That did happen for us. I'll just, again, specific, companies, it's hard for us to comment on. Microsoft is such a huge player. We showed you that chart of where it sits on the S&P 500. So I don't foresee that changing per se. It's certainly possible other competitors come to market, but I think Microsoft is a behemoth and is going to be with us for a while.
Great, thank you both. I know we're just 2 minutes on to the top of the hour, so we will begin to wrap things up here, but I do want to thank you for leaving your contact information for any of you who would like to have, future conversations with Paul and Adam. Like they said, the UB community, we're all one big community and family, so feel free to reach out to them with any questions you may have. But I do want to say thank you to the both of you for, again, sharing your expertise with us, giving us your time, and taking us through this presentation. I do want to turn it over to the both of you for any closing remarks or anything you'd like to leave the audience with today.
Well, thank you everyone for being here. Paul and I are happy to speak with you if you do find it of interest. Remember that the average investor tends to struggle, and that's where Paul and I kind of come into play to help people on their investments and retirement plans, and ultimately to get you better outcomes and a lot more from your finances and help you with your life and your standard of living. So that's, I think, what we would leave you with, and hopefully you took away a lot of good information from this.
Outstanding. Again, thank you, Adam. Thank you, Paul. Thank you all for joining us. We look forward to having you back for a future webinar. We'll be with you each Wednesday now through this fall season. So stay tuned for additional webinars coming your way. But thanks again. Take care. Stay well. Enjoy the rest of your day, and go Bulls.
Go Bulls.